So in this video we'll take a look at why people spread bet. At the end of the day you could simply buy an asset and wait for it to rise in price. Tesco shares for example. But actually spread betting offers potentially a faster, cheaper and leveraged, higher risk but higher return way of achieving the same thing. So let's take a look at why you might choose a spread bet over say buying shares. After all, both can be used to bet on rising prices. You either buy shares and wait, or you take what's called a long position with a spread bet, which is effectively an up bet on the direction of something else, such as Tesco shares. So how would you make that decision, and what are the pros and cons of either route? Well, first of all, let's pick something to bet on. So imagine that is Tesco shares. And we're looking at two possibilities. So one would be simply to buy the shares themselves. The other one would be a spread bet on Tesco through a spread betting broker. Now, leaving aside for a moment the mechanics, how would you make that decision? Well, it's a case of weighing up the pros and cons, and there are several. First of all, when you buy shares, a bit like buying property, you pay a rather annoying tax called stamp duty. So, if you're buying shares, stamp duty, normally paid at 0.5% of the purchase price, kicks in. With spread bets, there's no stamp duty. So it's only a small saving, but if you're a regular trader, that can add up. Then you've got a second tax, capital gains tax, or CGT. That's the tax you pay when you make a profit, not just on shares. But the problem is, unless you hide your shares in something tax efficient, such as an individual savings account, you'll be paying capital gains tax. So that kicks in there as well. Here's some good news. Not when you spread bet. You can make profits as big as you like with spread betting, and there's no capital gains tax to pay. What about commissions? So when you buy shares, for example, you'll be paying a commission to your broker. Now that could work out a number of ways. It might be £10 to buy, £10 to sell, maybe a little less if you trade regularly, but you'll be paying that commission every time you trade. With a spread bet, you don't pay commission as such. It's not free, spread betting brokers are not charities, but you don't pay a commission in the same way as you would with shares. So what do you pay? Well, when you buy and sell anything in financial markets, you normally do so at two different prices, the bid and the offer price, because the person doing the trade with you, your broker, is trying to make money. It's like second-hand cars. You go into a car dealer and mysteriously the same car has two prices. One if you're trying to buy it off the dealer, not surprisingly the higher price, and the other one if you're trying to sell the same car back to the dealer, the lower price. So just as second-hand car dealers operate bid-offer spreads, so does everybody across financial markets pretty much, including your broker. So when you buy shares, you will suffer what's called a bid-to-offer spread. So for example, if the so-called mid-market price of Tesco is £4.25, you might think, well, that means I can buy and sell it at £4.25. No, you'll probably be paying a little bit more than £4.25 to buy, and you'll get a little bit less than £4.25 to sell. And that's a feature of buying and selling shares. The name suggests it must also be a feature of a spread bet, and indeed it is. And that's something to watch out for. You will pay to spread bet, but you'll do it through the bid to offer spread, normally rather than separate commissions. Okay, what else? Well, one advantage of spread betting is so-called leverage or gearing. And what I'm going to suggest here is that when you buy, say, 1,000 Tesco shares at £4.25, you'll be paying the full purchase price up front. That will be around £4,250. However, spread betting, you can basically take a position of a similar size, but with a much smaller upfront commitment. And it's that ability to to leverage up a spread bet that gives it both its up and downside. It makes it a fantastic way to make quick profits, but also, if you're not sure what you're doing, quite a quick way to lose money too. So you will pay the full price to buy shares, as you'd expect. You don't actually commit the same amount of cash to spread bet. Now, to round off, just one other thing to be aware of, and that is shareholder perks. The biggest one is probably dividends. With a share, you also get the right to sort of vote at Tesco's annual general meeting, for example. The point about owning shares is you get them. So if you hold Tesco shares when a dividend is paid, you'll normally snap that up. Spread bettors don't normally get the same rights as shareholders. So you don't become eligible to vote at meetings, for example, if that's important to you, and you wouldn't normally qualify to receive any dividends for the length of time your bet is open. So in essence, spread betting. 3 real big advantages. Speed, tax savings, both in terms of stamp duty and capital gains tax, and also the ability to leverage up. And we'll see in another video that that is the ability to make quite a big profit or loss on a fairly small commitment up front.